dividend investing is regaining its popularity. But with the growth potential of tech stocks and index funds, some investors have lost sight of what dividends can do for a portfolio. The secret behind them is compound interest, something Einstein referred to as the eighth wonder of the world. But first, if you like free financial literacy content, like and subscribe and sign up for our weekly Rise and Hedge newsletter. Back to those dividends. Because of their ability to compound interest, they make for an incredibly successful long-term portfolio strategy. Growing a dividend snowball entails reinvesting your dividends to purchase additional shares at no out-of-pocket cost. In turn, these shares beget more dividend payments, which can be used to purchase more shares. This strategy can be accentuated by routinely purchasing additional shares out of pocket. Ultimately, the more dividends reinvested, the more your payouts will grow. Over time, your snowball accumulates to the point where it can sustain a FIRE lifestyle, or carry you through retirement without having to worry about Social Security. Here's an example of how it works. You own 100 shares of a $25 stock paying an annual dividend of $1 per share. After 1 year, your dividend distributions amount to $100, which when reinvested can purchase an additional 4 shares at $25. The following year, you now own 104 shares yielding $104 per year, which can be reinvested to purchase an additional 4.16 shares at $25. After year 3, the dividends from those 108.16 shares enable you to purchase an additional 4.32 shares, bringing your total to 112.48 shares at just the initial cost of $100. Thus the snowball continues to grow as it rolls downhill. However, this hypothetical assumes the company doesn't raise its dividend and the share price doesn't appreciate. By investing in companies with a history of raising their dividends, like dividend aristocrats and dividend kings, which have done so for 25 and 50 years consecutively, you're helping ensure that the overall yield on your portfolio isn't just maintained but steadily grown. Here's another example. You purchase 100 shares of Dividend King Altria Group at a share price of $40.34. The stock's gained 6.95% over the past 10 years and has a dividend yielding 9.72%, which it's raised for 55 consecutive years. In addition to those 100 shares, you invest another $100 per month every year into Altria, doing so in a Roth IRA for tax advantages. Altria increases its dividend by 4.3% annually. Now let's say the company's able to replicate its 10-year growth rate of 6.95% for 2 decades. After 20 years, the Altria component of your dividend snowball alone is worth $216,293.40. This would provide you with $45,767.06 in dividend income per year, or $3,813.92 per month. So while growth investing may have its potential, the beauty of a dividend snowball is that you don't have to sell the asset to generate income. You just let it grow and grow and grow, and when you need income, it's there for you without having to sell the underlying asset.